You moved money from equity to a debt mutual fund because you wanted safety. But then one day, the NAV dropped by 5 to 8%, and now you're confused. You thought debt funds were supposed to be safe. So, if they are safe, why did your NAV drop? This has actually happened multiple times in the last few years. In 2022, when repo rates jumped, long term debt funds NAV actually dropped. In 2020, Franklin Templeton shut down 6 debt mutual funds. IL&FS and DHFL crisis in 2019 and 2018 led to mutual funds NAV dropping by as much as 5 to 8%. So what really happened in all these examples, and how can you safeguard yourself against all these risks? In today's video, we'll discuss what debt funds really are, how do they work, who should consider them, its returns versus fixed deposits, and types of debt mutual funds. Second, the 3 most important risks most investors miss, and most importantly, how can you check them in under 5 minutes using just one document, the fund fact sheet. By the end of this video, you'll know how professionals evaluate debt mutual funds. I'm CA Vamika from the Wealth Palette, where we invest with clarity and confidence. Let's start from the basics. Debt mutual funds lend money to corporates, governments, and financial institutions. And in return, they earn interest. That's why people call them safer, because they are predictable. That doesn't mean that they are risk-free. But who should even consider debt mutual funds? First, you can start parking money in debt funds from equity before your goal starts approaching. Second, when you receive a windfall gain like FD maturity or a bonus, it could make sense to park that money in a debt mutual fund and transfer it systematically to equity. Third, to have a stabilizer category to manage your asset allocation. I've spoken about asset allocation frameworks in detail in this video. Do check that out after this video. Why even consider debt mutual funds when there are fixed deposits available? Because debt mutual funds typically give higher returns of around 1 to 1.5% across different investment periods. Of course, these higher returns come with higher risks, which we will discuss in detail in today's video. Before we get to the risks, let's understand the different types of debt mutual funds. Debt funds can be broadly classified, first based on duration and second based on investments. First, on duration, debt mutual funds range from short-term, overnight and liquid funds to medium to long duration funds. These funds are named based on the maturity of instruments within the fund. Example, a liquid fund would typically have debt instruments which mature within 91 days. But long duration funds would have debt instruments which have maturity of more than 7 years. Longer duration bonds get higher yields because of lack of certainty. Second classification is based on instrument type. The fund can invest in government securities, corporate bonds, or credit rated bonds. Example, if you're looking to invest in government bonds, then gilt funds invest 80% in government securities. Or if you want exposure in banking and PSU companies, then this fund invests 80% in banking and PSU bonds. Classification is important because risk changes completely based on which category you pick. Let's understand the 3 big risks you must check before investing in debt mutual funds. First major risk, credit and concentration risk. Basically, all debt instruments are rated by credit rating agencies such as CRISIL, ICRA, CARE. For instruments which have maturity of greater than 1 year, the rating is from AAA to D. AAA is the highest rating for long-term maturities. AA and A equal moderate risk. BBB and below equal significantly higher risk. For instruments which have maturity of less than 1 year, of course, A1 plus is the highest rating, and A4 plus onwards is when the risk starts increasing exponentially. Simply because these instruments have lower ratings, they have to pay higher interest to compensate for higher investor risk. So the extra yield of 0.5 or 1% you get from some funds may be on the back of investing in lower rated bonds. Let us understand this through the IL&FS example. In September 2018, IL&FS missed interest payments, which led to its rapid rating downgrades by these credit rating agencies. In the fact sheet, look for credit quality or rating allocation section. You'll see the exact breakdown there. How much is AAA or sovereign rated? Sovereign rated means Government of India issued bonds, which carry SOV rating, treated as equivalent of AAA or above. If the fund invests in mostly high grade, it's safer. If there's a big chunk in lower rated papers, it's riskier. One important thing, ratings change when new information comes to light. IL&FS was actually rated AAA before the crisis. Then it got downgraded rapidly when problems surfaced. So if ratings are not a guarantee, let's see how you can safeguard yourself further by looking at concentration mix. Many funds that held IL&FS had as high as 8 to 10% exposure to just this one company. So when it collapsed, those funds took massive NAV hits. If the exposure was just 2 to 3%, the damage would have been contained. So what should you also check? Top issuer exposure. And how spread out is the portfolio? You will find the exact percentages from the top holdings section in the fund fact sheet. Ideally, it's safer to have no single borrower have above 10%. If you see 15-20% or more lent to a single borrower, that's high concentration risk. Credit risk and concentration risk work together. If a fund holds low rated papers and they are concentrated in a few issuers, that's double danger. The takeaway from this section is credit risk is when funds invest in lower rated bonds for higher returns. This can be avoided by checking the credit rating of the bonds. For longer duration, AAA and SOV is the highest rating, and for shorter duration, A1 plus is the highest rating. Credit risk can also be avoided by checking top holdings and avoiding concentration in a few names. Second major risk, interest rate and reinvestment risk. Even if nobody defaults, your NAV can still fall. Let me show you how interest rate risk works. Suppose your fund owns bonds that are giving 7% interest. Tomorrow, RBI increases repo rates and the market starts offering 8% on newly issued bonds. Now tell me, who wants your old 7% bond? So to make it attractive, its price has to fall. And when the old bond's price falls, your NAV falls. That means when interest rates rise, your old bonds prices fall and vice versa. That means interest rates and bond prices are inversely proportional. Longer duration funds are affected more by interest rate changes because longer the maturity, higher the uncertainty. The one metric that you must check is something called as modified duration. It's like a sensitivity meter of your fund to interest rate changes. If modified duration is 3, a 1% rate change can move the NAV by about 3%. So if interest rate increases by 1%, your NAV can drop by as much as 3%. You will find the modified duration clearly mentioned. How do you interpret this but? If money is needed sooner, ideally modified duration should be low, under 3. If you have a longer investment horizon, that means you have the appetite to handle higher modified duration. But there's one more hidden cousin of interest rate risk called reinvestment risk. Bonds don't stay in the fund forever. They mature. And when they mature, the fund gets its cash back. The fund manager will then have to reinvest that money at whatever rates exist at that point of time. Suppose you invested in a debt mutual fund in 2018. The return on your invested value is called yield to maturity, short में YTM. Suppose YTM was 8% when you invested. You thought, great, I'll get 8% for the next 3 years. But by 2020, repo rates crashed. New funds yielded only 5 to 6%. As the old funds matured, the fund manager had to reinvest at these lower rates. Your actual 3-year return may be around 6.5%. Not 8%. That's reinvestment risk. So, your long term return depends on the future interest rates also, not just today's yield. Takeaway from interest rate risk is shorter duration funds are less exposed to interest rate risk, while longer duration funds are more exposed. Second, you can check interest rate risk by checking modified duration. This tells you how much NAV changes due to interest rate changes. Third, the cousin of interest rate risk is reinvestment risk. This means yield to maturity from the fund can change in the future due to interest rate changes. Third major risk, liquidity risk. The perfect example of liquidity risk in action is by understanding Franklin Templeton. These funds held papers from real estate companies, NBFCs, and low-rated credit assets. There were already liquidity crunch and volatility issues in the bond market and in the overall market during COVID. So when redemption requests piled up, the fund couldn't meet them because the underlying bonds could not be sold so quickly without taking massive NAV cuts. Instead of deciding to take NAV cuts, the fund house chose to completely shut off these funds and repay investors over the next 2 to 3 years so that they don't suffer a loss in their investment value. But because of illiquidity in the market and the nature of the underlying securities, investors in these funds had to wait for 2 to 3 years to get their money back. Liquidity risks are one-offs, but when they do happen, it can cause a lot of pain and anxiety. Hence, it's best to understand how liquid are the underlying assets in the debt mutual funds portfolio. Government bonds, PSU bonds, large corporate bonds, these usually trade easily, while lower rated papers or niche instruments are harder to sell quickly. You can again check the nature of the borrowers from the fact sheet. Okay, you now understand debt mutual funds better than most investors in the country. Our takeaways from this video are there are 3 types of risks broadly. First, credit and concentration risk. Credit risk can be avoided by investing in higher rated bonds. Also, check top holdings to avoid concentration in a few names. Second, interest rate and reinvestment risk. Interest rate changes lead to fluctuation in the NAV. Longer duration funds are more exposed to these fluctuations. Interest rate risk can be checked by looking at modified duration. Third is liquidity risk. Liquidity risk can be avoided by investing in government securities, higher rated corporate bonds, which are more easily traded. Now, the real question. Given these risks, where should you actually invest? Pure debt funds, hybrid funds, or multi-asset funds? They all sound safe, but they behave very differently. In the next video, I'll build a simple decision framework so that you can choose for yourself. If this video helped you understand debt funds in detail, do hit like and share it with fellow investors. And do subscribe to the channel to not miss the upcoming videos on detailed investing frameworks in this series. Thank you for watching. See you in the next one.